I wanted to speak to you today about something that we come across from time to time, and it can be quite complicated. And when it arises, many people think that there's no tax implications, but that's not the case. So, what happens when your customer gives you something, an asset, a piece of equipment, something like that, in return for your services? Let's look at a couple of scenarios. In the first one, let's assume that you're doing work for some small but fast-growing companies that you think could be quite valuable in years to come. So you agree to accept shares in return for your services. The initial value of the shares is negligible, but you expect this to grow significantly over time. The money value of the shares when received is your income for tax purposes. But how do you determine what the current open market value is? It may need to take into account the potential for future growth, but most of that growth will be subject to capital gains. In our next example, you've done some work and you've raised an invoice, but instead of receiving cash, you receive goods or services in return. Here, the basic valuation of the transaction is given by the invoice, and so you need to make sure that that equates to the value of the asset that you received. The rules in this area have not changed the current position, but is now written in law rather than based on court cases, which are now nearly 70 years old. Under the new legislation, where income is received in a non-monetary form as part of a trading transaction, the full monetary value of the relevant asset must be brought into account when computing the profits of the trade. Now, when we look at the tax position of any receipt, there are two important questions that need to be asked: whether the receipts are monetary or not. The first of these is, does the receipt arise from the trade at all? Is it received in the capacity as a trader or in some personal capacity? And here are some examples of these to give you an idea. Compensation is clearly personal, but if it's for personal injury, it must be suffered by the proprietor himself and no one else in order to be exempt from taxation. It also follows that companies cannot be exempt from tax for receipts for personal injury because those injuries are to its employees. If we're happy that the receipt is derived from the trading activity, then the next question is whether that receipt is capital or revenue. Capital receipts are largely for the disposal of assets, either fixed or intangibles, and while these may have tax consequences, they will be treated separately from the profit and loss account. Now let's turn our focus back to non-monetary receipts, and here is a line from the Revenue's own manual. What it means is that for an asset to be taxable as income, it's got to be capable of being turned into money. So what does this all mean for you and me? Employees receiving gifts, i.e. benefits, either from their employers or from another employer, are likely to find that they're taxed as receiving benefits in kind. But this does not apply to traders. And so there's an advantage there for the sole trader or partner, who can therefore receive rewards provided that they are not convertible into money. Let's take, for example, a trader who receives a holiday, perhaps for being a good customer. The gift is non-transferable, it's not convertible into money, doesn't represent money or money's worth, and therefore, as far as that trader is concerned, is not a trading receipt. I think there is limited planning potential in this, but it might be that if you have a particularly good relationship with one of your suppliers who wants to give you a bonus, then perhaps there's a discussion to be had. I'm Alan Long from the Long Partnership, making life less taxing.